Good morning. It's February 22nd. Actually, it looks like it's midday now. I'm Rich Positive for Critical Point Podcast. And this is a little update of something different here that people are watching and has the stock market a little concerned over rising interest rates. And this chart was put out by someone at Zero Hedge, I think, or maybe they copied it for someone else. But what they've done is taken copper prices and divided by gold, and the ratio is exploding because copper prices are exploding. And what they've done is overlaid a chart of the 10-year T-note U.S. Treasury note yield, okay? And look at the correlation. It's very fascinating. It's had its moments. It wasn't quite right, but it's done quite well. And it has been turning up along with this ratio, okay? I think this is telling us, yes, copper's rallying because the economy's growing, commodities are better, inflation's picking up, business is being done, and for somehow reason, though, that's moving faster than the gold market. The gold market's really not picking up on the higher inflation. And I think there's a delay going on. I don't think the inflation numbers are really picking up on what's really going on out there. And then therefore gold is watching inflation numbers too much and not picking up on really what's going on out there. I think this could be a characteristic of when you're coming out of a recession. We normally see a tick up in inflation. We see a rise in commodities. We see a rise in interest rates. And it's normally a good thing. It's a good sign that we're growing the economy. Later on, that can get out of hand. Inflation can get too high for too long, and the same for interest rates. And then there is reasons to worry, okay? Now, what they're saying is, if this is the case, we may well see this interest rate snap back up to a better correlation, meaning it's going to rally now faster than the ratio. And they're saying, whoa, we could have a much bigger run up in interest rates. Well, I truly believe I called the super cycle bottom for the 10-year note in August. I believe I caught it correctly. I don't think we'll see interest rates that low as low as it was in August 21. I don't think we're going to see it for maybe a decade and a half and much later. I could be wrong as soon as the end of this decade, though, on super cycles that can come in sooner than they're supposed to for a 1929 crash. But I don't think so. I think it's going to take longer than that. Okay? So I think it made a fantastic call. So it doesn't surprise me that we're seeing an abrupt change, an abrupt wake-up in interest rates. At the same time, I'm not so sure there's a reason to get all bent out of shape of higher interest rates. These things can stall out. We get slugs of supply on the bond market as they dump bonds to get their hands on their cash so that they can plug it into the stock market, commodity markets, go out and do business, build things, buy things. I think that's a healthy thing. So I'm willing to forgive the higher interest rates because of that selling of the bonds, okay? I think it's a good thing. But the stock market, at least as the last couple of days, people have been concerned that that's what's going on. The stock market is worried over those higher rates. So I'm more inclined to think this ratio is going to start stalling on the copper gold. Maybe it's gold start catching up, copper starts slowing down, and the ratio starts pulling back even, or at least slows down. Interest rates do look like they're starting to speed up. They're starting to get a little bit of a curved kind of shape going on in here, maybe even here, or at least a linear, and it's now breaking out of the linear. So yeah, maybe they're going to head higher on up to, eventually I think we go to 2% or even higher over time. But is it necessary to do it right now? So let's go take a look at copper and see if we get some clues. So here's the copper chart. 3-year business cycle back with the Great Recession. Good chance there was much more longer term, even minor super cycle bottoms going on there, but we'll just leave it for the 3-year. Slams up for 3-year. Now there again, we start pulling out of the recession. What'd they do? Bought copper like crazy. Well, what are they doing coming out of this recession? They're buying copper like crazy, stumbling over one another. Literally stumbling over one another as they rush for that buy door or that buy window. We see, however, the 3-year business cycle eventually worked inside of 5 to 7, 9, or 5 to 7 type year cycles to bring things back, even though the commodity economy was still growing. Copper can be a good economic indicator, but you have to realize when you put price higher, maybe it's reflecting a strengthening economy and good demand for copper, but eventually a high price becomes a microeconomic and brings in more supply and even eventually hurts the demand for copper, but it does not necessarily mean problems for the economy. The economy can continue to move forward, and that's just what we've got. So I think this rally in copper is correct, and But what I'm wondering is, how long is it going to last? How high is it going to go? We had major resistance at $4.50. Okay? I think that's major resistance again. And here's a scenario I want to point to you. I can show a 3-year business cycle top as of January 2020. And if that's the case, it won't top out to next year. And what am I looking for the stock market? To give us a 3-year business cycle top next year, and we should have a correction a little bit before moving higher later in the decade on into 2024. But that can also mean a little bit of a hiccup, if you will, or a speed bump or throttling back of the economy then. So the point is, copper could remain strong until next year, then down, but it could be that it only stays up a few more months and then stalls out, puts in some kind of topping formation, and tops out ahead of the stock market for next year and ahead of the economy. Now, I have another scenario, and that is I can move this 3-year business cycle top to right now. I'm willing to give it 1, maybe 2 more months, meaning I think it pops out no later than April. Under that scenario, this would be the latest for a 3-year cycle top, really stretching it. But the beauty is it could then go lower into 2022, meaning it starts down well ahead of the stock market, starts down well ahead of the economy, but it may not be because of a slowing economy. It may be a micro thing where the demand's backing away because, hey, you put the price up too high too fast on me, okay? We all stumbled to the same door too much. Are we a bunch of idiots? What? Let's calm down here. We can get a better price somehow, some way. In addition, as we pull out of this virus recession, we're going to eliminate some of those virus recession supply chain complications, demand chain complications. We're going to get back to normal business, which eventually means these prices are going to buy more copper, okay? And eventually they're going to erode. My number one forecast for you is look for a minor long-term business cycle top now in the next 2 months. And this thing's going to calm down into next year. Okay, I say calm down at first. Don't know if it's going to fall apart by no means. Wouldn't be surprised it can come all the way back to $3. Doubt it's going any lower than that, and here's why. There's a good possibility a 9-year business cycle top occurred in 2010. This is not enough waves of buying and selling on a long-term basis, enough 3-year business cycles and a 6-year and whatnot to put in another 9-year. This market, the copper market can be this high and higher and may even go above 450 by time of 2024. But again, I could say that it could be this high, meaning it can turn sideways at some point. But within that, it should still set back next year. So I think we got to give it an opportunity. If it's going higher May, June, I'll probably give up and say, you know what, even if it has sizable drops, it's probably going to snap right back. It's going to remain firm into next year. Then we'll get the pullback. We'll just have to flip to scenario number 2. That's all we can say. So scenario number 1, time for a long-term top in copper. And I don't think it will mean a darn thing for the economy and the stock market. They're going to keep on moving forward. But it's done its job of being supportive of the economy. It's telling us people are trying to take advantage of that virus recession. They want revenge. They want to get out there. They want to do business, and they need copper, and they're getting it done. But this is partially due to that supply and demand chains, distortions, distractions, disruptions, whatever you want to call it, complications, all right? I think we're going to get back to normal. We're going to bring copper down. So what's that going to do with the ratio? Well, it should start giving it a headwind. It should be more difficult for that copper-gold ratio to go. Well, what about gold? I think over time, gold will perk up on the inflation story. Right at the moment, I think it's got its own little supply issue and microeconomic issue. And I also think Bitcoin is stealing some of its thunder. But I think gold can be at least stable for quite a long time to maybe up somewhat in the next few years to kind of reflect inflation. Late decade, I don't think gold will be doing well, even though the stock market's going higher and the economy's doing great. Just my gut feeling. All right. But I can see between the two that looking out to next year, I say there's more downside in that gold or copper to gold ratio than there is upside. I think there's more time to go down than to go higher. But the trend is up and it's strong and it's looking impressive. Now the question is, what about interest rates? So here's a monthly chart of the interest rate of the 10-year Treasury note. Basically, just call it the bond market. And in August, right, there's the bottom. I called the bottom and I said, this isn't just a little long-term bottom or a trader's inter-year kind of bottom. This is a super cycle bottom that occurs maybe once in your lifetime. Okay? Could be that important. I decided to then forecast how long it'll last, and I think we can have higher interest rates the next 15, 25 years. There could be a disruption at the end of this decade that's quite serious, and I think we'll at least see the interest rates come down somewhat from a normal decade recession, a cyclical recession, and a bear market of 20 or 30% in the stocks, and we'll bring the interest rates down to coincide with that. But that doesn't mean we bring interest rates all the way back to the 2020 lower. I seriously doubt it. Now, there is a chance for super cycle downturn to show up by the end of this decade instead of later. Maybe that could prove me wrong and they bring interest rates all the way back. But that's a different story. We'll deal with that as we get closer to the end of the decade. There could be something more serious going wrong. My guess, though, is that seriousness stuff is going to delay to late 2030s. So, in other words, somewhat of a setback in interest rates into this decade, then another rally in interest rates as we have another economic boom. Then we get the super cycle downturn where rates may come back to this level. Back to the level of last year is what I'm saying, okay? And maybe even lower, because it could be a 1929 crash scenario. But I think that's a long ways out. And the best forecast is we got higher rates the next 15, 25 years. Even though rates can surge too fast several times this decade and cause problems for the stock market, overall the stock market is going to go higher anyways. But it can definitely have level 2, level 1, even level 3 downswings that last a few days to a few months just because of interest rates. We're going to have to deal with it as stock market bulls. That's what they're going to do. I think they're nuts, but that's normal behavior of what they've done over a long period of time. They're going to do it again, and they've been nervous the last couple of days. I think they're going to get over it very soon, frankly, at the moment. But where are we going in this larger structure? And what I believe is we had a secondary recession back in 2015, 2016, mostly for commodities, manufacturing, that kind of stuff, not the services industry, not the overall economy. It slid under the radar screen of economists, and I kind of thought of it, but it really didn't. It was a year or two later they said, oh, you know what happened then? All right, at any rate, super cycle bottom, however, with the global recession, the U.S. recession, the virus recession, it's over. It's a bull market. The bond market is telling us the recession's over. All right, now the problem is we have a K economy, though. So there's some people who are really hurting. There's some indicators saying, no, we're not out of the recession yet. We got work to do. But for the moment, the bond and stock markets are basically focusing on anybody that has a job is probably doing okay to good to fantastic. So they're zooming in on a range within that range, and they're excluding the people who are unemployed. They're literally just forgetting about it. That's the stock market for you, okay? And now even the bonds, which the bonds normally a little more, they're more worried over everybody and they have a better feel for the economy. But I think the bonds are literally forecasting saying, yeah, but you know what? We're going to fix this K economy. We're going to get that next stimulus package. It may be bigger than we think. There's all kinds of things they're looking at. And I think they're selling bonds, sucking the cash out of it, going to put it in the stock market, commodities, and a few other things. Real estate. Okay, here's my forecast. The bond market can actually top as soon as next month for a 3-year business cycle top. Now, that's your minor, smallest type of cycle. If you're trying to find something similar, and it is a bit different, but it would be the kitchen cycle you can find on the internet. KITCHIN. And it was in economist Schumpeter's model. Okay, I have a little bit different definition, and I come up with my own name because I also use it over in commodities, temperature, precipitation, things that are non-business. Okay, any rate, we're going to get a 3-year top, but the problem is it can extend all the way into the end of the year, so it can still go higher all year long. A 3-year business cycle bottom is due next year. That tells me I'm on the right track with the stock market coming down next year, because there's probably going to be a little bit of worry over the economy, or more likely it'll be a worry over the future of the economy, and to get it wrong, we don't really have a problem. But we'll still knock these markets back. So they can cool down this interest rate bull market a little bit. Some of the commodities are due for a setback next year. Okay, we may see a spike in the dollar even if the long-term bear market's intact for the dollar. So my guess is we have to be a bit cautious here and say, you know what, they can rally interest rates all year long, but how high are they going to rally it? I don't think they're going to rally it more than, say, 2%. And I don't think that's high enough to get all flustered and say, well, this is just going to cause problems for the economy and the stock market. Number one, I don't think the economy is going to pay any attention to that. Number two, the stock market may pay some attention, but I think basically the stock market is still going to do well all year long. So my guess is 2% isn't that outrageous. But if we're going to get 2% in just the next few months, that could be too fast. And this is where even if copper tops out now, and maybe even gold perks up, and the ratio tops out and starts coming down, we can still see interest rates go up for a while. But my thoughts is that the interest rates are just not going to rally enough on that ratio they're just not going to be that explosive to catch up to the ratio where what some are talking about, that they're fearful of. That's going to be a combination of bringing the ratio down, bringing interest rates up a little bit more. And that's about it. So that's my gut feeling. I may have to set up other objectives and it goes even higher. And I think this year, maybe this is going to be a massive surge. There's definitely some big boys out there betting big, big money that we got a massive inflation run coming and all kinds of complications and problems. And if we go there, yeah, something has to give. You got to be wrong on something. So I'll probably be wrong on the stock market. I just don't see it. I think stock market goes up this year. So my guess is they can't give us that much problems from interest rates. So I'd be bullish for a while in interest rates, but you just got to look for a 3-year business cycle top from March on into the end of the year. Very long time. I know it. I would tend to think it's probably not going to top the summertime because that's when the economy seasonally should be doing its best. Everybody's back to work trying to get something done. And then later in the year, we start laying people off. The seasonal starts flipping the other way. And then, yeah, it could still make another, the stock market economy could still be up early next year, and then we get a little bit of a setback. But I think it'll only be a little bit of setback. So even if it goes to 2%, what will be the rate for next year? I think it doesn't go any lower than where we are now, like 1.3% or something like that. So you may want to start dialing in a range of interest rates into next year. And I don't doubt by 2024, we will be ready or should be prepared for another 3-year business cycle top that would trigger another 6-year business cycle top. So it might get into a secondary recession by mid-decade, and that's fine. That's normal business. The stock market may not even notice it. Economists, it may slip under the radar screen just as it did in 2015, 2016. But we'll probably have some shaky times in the stock market. So hopefully this is some help to you that, yes, I'm a super cycle bull in interest rates. I think I just made a miraculous call here August of last year. If your commercial rates, private rates are still weak, still going down, they will catch up, especially now, I would think. So you might prove a little later bottom. That all works in with what I was thinking. I'm fine with it, okay? So at any rate, I want to be cautious here of just how much these rates are going to pop. I hope they don't get too carried away because they definitely can cause problems in the stock market. But my guess is going to be normal behavior, and we're going to have to deal with this kind of thing several times this decade. But overall, somehow, some way, inflation goes up, interest rates go up, economy continues to grow, and the stock market goes up. That's our sweet spot scenario. Okay? Thank you very much. Manage your risk relative to others.